the big winner up until this past year over the last 10 years has clearly been the S&P, and particularly the growth segment or growth portion of the S&P. Certainly this year, some of the non-U.S. equities that we own have doubled the performance of the S&P. Still, multiples are much, much cheaper. There does seem to be a little bit of a trend, and it doesn't mean that we don't still outweigh our portfolios in U.S. equities. We do. I mean, the U.S. market, we still think is the greatest market. There's the greatest innovation, and we will always have an overweight to U.S. markets. But at the same time, we'd like to have about 25% of our equity exposure in global assets and in non-U.S. Equities. We like Asia. We like the demographics. And again, we like the overall earnings per share ratios of a lot of these stocks. So we will continue to own non-U.S. equities, and it also gives us a little bit of a hedge for the dollar as well.